All right, Pankaj Murarka joins us, and this market has not changed him at all. He's still that happy-go-lucky guy, right? Doesn't matter. 10% correction has come and gone, right? What did you do in this fall? How did you deal with this decline? Did you make any large changes?
Well, yes, Nikunj, we have in the last 3 or 4 months, we have made changes after a gap of almost 5 years now. I have turned positive on consumer as a sector, Nikunj, meaning I have been negative on consumers for the last 5 years because of my concerns around slowing growth and expensive valuations. I think both of them have turned around. So I think valuations now in consumer sector are much more reasonable. And I can see a path to a growth acceleration in the consumer sector over the next 2 or 3 years. So that is one sector where we've avoided largely over the last 5 years. And now we have a meaningful exposure in the portfolio, and we have actually gone overweight versus benchmarks because we are long only. So in a sense, we are relative investors. So we have gone overweight on consumers in our portfolio. So that's the one big change or delta that we've made in the portfolio. And I can lay out my hypothesis. Essentially, if you look at the last 15 years, the private final consumption expenditure has grown ahead of nominal GDP growth. In the last 3 years, the growth is under 5%. So I believe that over the next 3 years, we'll see a sharp rise in private consumption, or the PFC as we call it. And I can see, the green shoots in terms of stars aligning for that. Inflation has surprised us on the positively after a gap of 3 years that we have seen a monthly inflation print, which is undershooting 4%. That, to my belief, I have a non-consensus call that we have another 75 basis points of rate cut during the course of this year, and probably 100 basis points in the next financial year. So I think India has the highest real rates in the world. More importantly, I think the tax and the government has made a pivot. The tax break should certainly help because that's a very significant amount eventually. And more importantly, the government has announced the formation of the ninth pay commission. So next year, the pay commission recommendation should be out and will get implemented. And we have seen whenever we have the new pay commission recommendation getting implemented, given the large pool of government employees and defense forces, it has a meaningful impact on the consumption. So I am positive on consumption or consumer as a sector over the next 3 years, and I think that will be a big driver of growth going forward.
Starts with good old Asian Paints, and it cuts down to Zomato.
Well, paints as a category has a challenge, Nikunj, because there the challenge is from a market, organized market, which was just about 3 or 3.5 players. Now we have all of a sudden we have three incremental players. So the competitive intensity in that space has increased significantly, and that is likely to remain in the medium term. So despite Asian Paints being a great company, uh, there is a heightened competitive intensity, which and they will end up conceding some market share. And more importantly, it will lead to some pricing pressure and margin pressure in the industry. So probably I think paints is still avoidable. But I think what looks more interesting on the consumption side probably is staples, because I think given the fact that we're coming from a low base of consumption, I think staples will do well. On the discretionary side, probably we like more durables, and probably some of the discretionary category across travel, tourism, and probably some of the retail stocks, probably where we'll see the operating leverage is very high in the business model. So a small uplift in growth can have a significantly higher impact in terms of profit growth and cash flow growth.
Uh, let's talk about the digital businesses where you've made a lot of money, a lot and lots of money, right? You still own Zomato, you still hold Paytm, you still hold the others?
Uh, we still continue to own Paytm. Zomato is where we have taken some money off the table because we again think that as far as the food delivery business is concerned, at current valuations, a lot of that is priced in from a next 3 years perspective. And on Blinkit, which is which eventually will become a bigger driver of growth, we are seeing heightened competitive intensity and significantly higher investments. So I still think while the stock has done pretty well and we own it, but I still think that probably it can go through a period of consolidation over the next 12 to 18 months, and probably it could yield it might, the stock price might not yield returns in the next 12 18 months. Slightly more longer term, I still think it remains a good investment. Paytm we still continue to own in that sense. Yes.
Pankaj, let's look at IT. Now, there is a lot of yes and no. The minute I say IT, there is AI. The minute I say IT, there is fear of US economy slowing down. But there are a lot of niche IT companies which are now coming up. How should one look at this entire niche IT space now?
Well, niche IT is always a challenge, Nikunj, because my experience of investing in these companies and looking at this business over a long period of time, over the last 25 years, these kind of companies, they go through their own growth cycles. So there are periods when they deliver very strong growth, and then they have their own challenges of growth, and they get into a cyclical slowdown, and that could be completely due to either their customer concentration or the TAM or the segment that they're addressing, limitation of its own, and so on and so forth. So one while playing niche IT can never be a secular growth story, because these companies and the growth cyclicality in the growth tends to be much higher in these companies versus broad-based IT companies in that sense. So one has to be slightly more careful in terms of investing into these companies, because in a downturn, when they go through a growth slowdown, the growth drawdown or is much sharper in case of these companies. So and then picking a winner which can deliver sustainable growth over a long period of time is always, an art, I would say, in terms of require significant stock picking skills in that sense. So one has to be, and experience tells us that most of these companies, once they reach some critical size, they tend to hit some sort of an air pocket where then beyond that they really struggle to grow. Meaning the only success we have seen is in case of ER&D companies in the last 5 years post-COVID, where the world has seen a significant acceleration in R&D spends, and which is where some of these ER&D companies are now breaking out of, are the larger company has broken out of the billion-dollar revenue club, and now let's say LTTS or L&T Technology is now aiming for $2 billion of revenue, and other companies are still targeting to get to $1 billion of revenue. And mind you, some of these companies are targeting $1 billion of revenue over the next 3 years, but they've been around for 20 years. So it's taken them 20 long years to get to $1 billion of revenue. So one has to be, it requires really stock picking skills to be invested into these companies.
I'll twist and move to the other sector. Some may call it boring, some may call it ordinary, some may call it regulated. This entire power space, where strong summer means more power demand, strong balance sheets means more expansion, shift to green means more orders for Varis and the premiers of the world. Where are you picking your spots in this good old power space? Because some are buying utilities, some are buying transmission, some are buying finance, some are buying machinery, and there are few buying everything.
Well, we own some of those utilities, including NTPC, and I have a small exposure to Tata Power in some of our portfolios. So probably we like to play it through them. As far as some of these capital goods or power-oriented engineering companies are concerned, while we owned them for a while, but we exited most of them or all of them late last year, because valuation in the sector has become extremely rich. So I think the broader power story still remains very much in place in terms of, and power deficit in India, even from a slightly more medium-term perspective, and a strong power growth, given the strong underlying growth. India, mind you, we have transitioned for a period of 12 years between 2008 to 2020, we had power surplus. From there, we have now got to a situation, and we had no capacity addition on the thermal side in the power for almost 12 or 15 years, because we had excess capacity. So now it's only in the last 3 or 4 years that we have, the demand is part of its supply, and we have got again back to a situation where we are started setting up new thermal plants, and the solar and the wind story has been doing pretty well in that sense. On some of these solar EPC companies and the solar equipment makers, we believe the valuations, while they have corrected a bit, but there's a longer term question mark in terms of what is the sustainable competitive edge these companies have, apart from just being the low cost producers. So that's we can't figure out that at this point of time, and which is where we think from a slightly more medium term to longer term perspective, there is a significant risk to the business model, and which is where we've stayed away from solar products companies or the EPC companies in that sense, because we don't find significant value add, and more importantly, sustainable moat in these businesses.
Pankaj, so good having you on the show. Thanks as always for your time.
Thanks, Ash.
If you like this video, then like, share and subscribe to ET Now.